So the Strait of Hormuz moves 20% of the world's oil supply every single day. And on February 28th, it effectively closed. And ever since then, global economies and public markets have been on an absolute roller coaster. Now, market perception has been so sentiment driven for so long that it's really genuinely hard to know whether there's an actual problem or there's just fear of a problem. All right, so here's where the mainstream financial media keeps getting this wrong. When oil prices spike after a geopolitical event, the market usually calls it a fear premium, a threat, a sentiment, panic. But that framing fits the wrong problem because the market's so used to framing everything in terms of fear and of sentiment and not fundamentals and structural issues. It's just a default mode. And it doesn't actually fit what's really going on right now. Let me paint this super clear. Oil tanker traffic through the Strait of Hormuz collapsed. And to be really direct about it, no one thinks that Iran was ever going to bomb every single tanker that was passing through, but the risk of that happening went up substantially. And because of that risk, insurance companies either pulled their war risk coverage altogether or they raised their premiums so high that Middle East oil producers found it simpler and more financially viable to just store their oil or shut down their production entirely. Physical barrels of oil are trapped as a result, and a large share of the world's spare capacity sits behind the exact choke point, the Strait of Hormuz, that's causing the problem. Now, before the Iranian strikes, there were 135 tankers that passed through the strait every single day, carrying around 20 million barrels of oil and oil products. Now, that's 20% of global daily supply. And since those attacks, fewer than 10 tankers a day have made that crossing through the strait. Now, major insurers pulled war risk coverage for that region entirely, and without that coverage, a $200 million tanker is going to sit still. That is a physical fact. It is not a sentiment reading. It is not a fear premium. West Texas Intermediary crude went from about $68 a barrel to $76 to $95. It briefly touched as high as $115 a barrel and settled near $102 for the average of the month of March. And as of the day that I'm recording this, West Texas Intermediary crude is trading at about $99 a barrel. That's 30 to 45% increase in a matter of days. So when somebody tells you that this is just a fear premium, point them to the tanker data. The oil is physically unable to move, and that distinction matters a lot more for how you respond to it. And it's also why Donald Trump tweeting that a deal is close and the strait is about to reopen really has zero effect on prices right now. Because fear premiums respond to the words of politicians, but physical supply disruptions do not. Because words do not move barrels of oil. So here's where the analysis gets really interesting and where most of it starts to break down. So the first thing that every analyst says during a disruption is don't worry. Right? Gulf producers will open up the taps, there's spare capacity. Now again, right answer, but wrong problem. The Gulf producers, Saudi Arabia, the UAE, Kuwait, they hold the lion's share of global spare capacity, about 4 million barrels a day. So what keeps getting buried in the coverage is almost all of the spare capacity exports through the Strait of Hormuz. The relief valve is inside of the locked room. And because storage is filling up with oil that has nowhere to go, Gulf nations have been forced to shut in at least 10 million barrels a day of production. They're producing it, then running out of places to put it because they can't export it, and so they're shutting down. Alternative transport routes exist around the strait, but they top out at being able to handle maybe 3.5 to 5.5 million barrels a day. So that's 14 to 17 million barrels a day that literally can't be moved. And with storage capacity gone, the only option is to shut down production. So it's worth sitting with this for a moment. The industry spent years underinvesting in new supply since 2014 while congratulating itself for discipline. Now, some of that was real, some of that was healthy, but most of it was idealistic, identity politics, disconnected from how energy systems actually work. Now, either way, the result's the same. Even at higher prices, the system can't just flip a switch and flood the market with new barrels. The IEA estimates that global supply lost 8 million barrels a day in March alone. That is the current state of the market. So what's keeping prices from going even higher? Well, there's two things right now, and they're both temporary. The first thing is inventories. I mean, global observed inventories sat at about 8.2 billion barrels going into this Iranian conflict. That's the highest number since February of 2021. The market was actually modestly oversupplied before February 28th. Now, the good news, and it's a little bit uncomfortable to even call it good news, but is that buffer exists to buy time. And that's all that it's doing. And that time is running out. The IEA actually recently coordinated the largest strategic reserve release on record, 400 million barrels of reserves released, plus roughly another 140 million barrels from Russian crude and Iranian oil that was drawn from sanctioned stock. So here's the number that you really need to know. Around mid-April, those reserves and sanctioned barrels will run dry. So even with a diplomatic resolution tomorrow, even if the Strait reopens completely tomorrow, Gulf producers need 3 to 4 months minimum to safely restart shut-in production and resume their normal export levels. And so that gap between the buffer running dry and supply coming back online is what I'm calling the oil cliff. The market is operating on borrowed time, and that time has a very specific expiration date. Now, here's where the conversation shifts, though. From crisis to opportunity. See, demand is under pressure, especially in Asia. I mean, you've got Asian countries that are already restricting the purchase of oil, that are keeping people at home from work, but it's holding right now better than the bear case assumed. So high prices do slow down consumption a little bit, but they do not make oil irrelevant. And when supply tightened, countries rationed fuel. Like I already mentioned, they reached for emergency reserves. They proved again that the world is far from done with oil. And that is physics, not ideology, not identity politics, which means that production that has no exposure to the Strait of Hormuz becomes disproportionately valuable overnight. So the Permian Basin matters. Guyana matters. Brazil matters. The Anadarko Basin in Oklahoma matters. The Bakken in North Dakota matters a lot more. See, U.S. production was already at a record 13.6 million barrels a day going into 2025. Now, the Permian Basin alone accounts for almost half of that at 6.6 million. And that's nearly half of everything the U.S. produces in terms of oil. Now, the S&P 500's energy index posted its sharpest single-day gain since early 2024 on March 26th alone. So to be honest about the framing, companies can generate serious cash in this environment. But that does not mean that they can ramp fast enough to solve the supply problem. So what this looks like is a disciplined capital cycle being stress tested, not a clean expansion opportunity cycle. So what you're watching is a wealth transfer from the Middle Eastern Gulf to the Permian, to the Atlantic Basin. Every barrel that the Gulf produces that it cannot move is a barrel that the Permian and Atlantic Basin producers are able to sell at premium prices. And a resolution does not erase that immediately. Now, every thesis has risk, but here are the three scenarios that I see potentially playing out. Scenario number one is they make a deal before mid-April to de-escalate the conflict. And that feels like good news, and it is, kind of. But even if the Strait of Hormuz reopens tomorrow, the oil doesn't just start flowing again. Gulf producers will need 3 to 4 months minimum to safely restart everything that they've had to shut down. You can't just flip that switch and let the oil flow. So here's what that actually looks like in practice. You The price that you see on your trading screen might drop fast because markets love good news. But the actual price to buy and deliver a physical barrel stays high because the barrels still are not there yet. And if you're watching this play out, that gap between the paper price and the real world delivery price is the signal that the market has gotten ahead of itself. Now, scenario number 2, the strait stays closed past mid-April. And this is the one that keeps me up at night, honestly. That's when the emergency reserves run dry and there's no new supply coming back online yet. At that point, you're looking at actual legitimate shortages, potential fuel rationing that goes beyond Asia. Now, Goldman Sachs is already putting a 30% probability on a U.S. recession in the next 12 months. Europe is staring down stagflation, meaning slow growth and rising prices at the same time, which is the worst combination that a central bank can face. And then there's scenario number 3. The conflict gets worse. I mean, the Qatar LNG strike already knocked out a third of global helium supply and a serious chunk of liquid natural gas capacity. So if the conflict spreads further, we're in completely different territory. That is the tail risk. It's a low probability, but the consequences would be severe enough that it's worth knowing that that possible scenario is on the table. So let me close with this. Energy security is far more fragile than most people are willing to admit. And that lesson tends to stick around a lot longer than the headline that initially triggered it. Emergency rationing, record reserve depletion, a 45% price surge in a matter of days. These are all symptoms and proof that oil is not a commodity that we are moving away from as fast as the idealistic headlines would tell you. The world is still completely dependent on oil. I mean, watch the tanker counts. And I don't think it's a good thing for it to last a long time because it causes the price of everything to go up and shakes the entire economy. It's not good for anybody. But if you believe that green alternative energy is the way of now, and we have any, we've moved meaningfully away from our dependence on oil and gas, then let this be your wake-up call. That's all I got for you today. Thanks for listening to On the Exit.